Good morning, everybody. Good afternoon for some places. We are very excited to host you for day 2 of the Insolvency Law Working Paper series. And for the first part of the day, we're going to talk about 2 idea papers, which are going to be responded to by an excellent panel. We're very excited to have kicked off yesterday in a very interactive fashion, and we are excited now to introduce the next 2 sort of idea papers on sovereign debt insolvency and third-party funding in insolvency. Our collaborators, thank you again, Insol India, Red Intelligence, Vidhi, who are supporting today, and Insolvency Law Academy that is supporting our final day on bank insolvency, which will be on Monday. I want to, for today, at the very get-go, invite Dinkar Venkat Subramaniam, who is the President Designate of Insol India. Thank you very much for supporting these working paper series where you are effectively consolidating policy, academia, and practice. And I want you to say a few words before we kickstart today's date and invite you to deliver the opening address for day 2 of the Insolvency Law Working Paper series. Over to you, Dinkar.
Thank you so much, Ishana. Good morning, good afternoon, whichever part of the world that you're in. Everyone, thank you for joining in on a Sunday today. Thank you again to Jindal Global Law School for these JGILS 2 and the Insolvency Law Working Paper series. I think you guys are doing a fabulous job in terms of taking the law forward, in terms of evolving it further and solving some of the challenges that we have and some of the future issues that and thinking of them and trying to see if we can find solutions to that. So continue doing a good job. Let me quickly talk about 2 aspects. One is, I know the evolution of IBC has been talked about a lot, but I just wanted to spend 2 minutes on that. The IBC, when it came, it wanted to ensure freedom to anybody to start a business, freedom to continue a business, and freedom to discontinue a business as well, quickly, easily, and how they would want to. And it has been a landmark reform. I've seen laws come in India, and we've struggled with the implementation of these laws. But IBC has been a clear exception to that. The speed with which the law was enacted and put into practice is just unparalleled in the history of lawmaking and implementation in the country, especially the intent and the intensity of the government and the Reserve Bank of India to take a nascent law with a work in progress ecosystem around that and test that almost audaciously by putting the most complex and the largest insolvencies is just baptism by fire. And I think we've been the better for that, and we thank them for this bolder step. And this was supported by the Supreme Court, by the judiciary as well, in terms of ensuring that the law holds on. As a result, by June 2023, we've got nearly about 2,600 odd corporate debtors that have been out of insolvency, 720 successful resolutions, about 900 withdrawals, and about 1,000 appeals or settlements that have happened. Nearly over 3 lakh crores have been returned in terms of recoveries to the creditors, which have been about, in terms of successful resolutions, about 32% of receipts, recovery of claims, which have been about 167% of the liquidation value and about 84% of the fair value of these assets. And in addition to that, about 150 companies have been liquidated as well. But having recounted some of these, it also appears through discussions and through various discourses that the IBC has slowed down and we're not getting the results that we want out of that over the last few years or so. But I would say just to again put that against data, the NPAs, the banking system NPAs or NPLs as we call in the rest of the world, those were about 12 or 13% at a peak in 2016-17 or so. And those have reduced to about 3-4% today in the banking system. And large credit to that would be because of the insolvency law, but also, I guess, the business the business tide has changed, the economy has revived, and it's going on. But removing that logjam has also been credit to IBC, and the biggest benefit of this has been the change in mindset of the stakeholders. Today, before it goes into insolvency, the stakeholders are intent on resolving this even before they think of the insolvency process. And stress has been identified earlier, resolved earlier through outside of insolvency mechanisms. This is also, I would say, given, and we talk about third-party funding later, but then this has given a huge impetus to what I call the private credit space in India as well, because pre-insolvency resolutions have seen billions of dollars come in through these alternate funds or private credit funds, and have helped either take out existing lenders or have them bought out by asset reconstruction companies and supported the resolutions of these through effective prepacks. And where there is value, people are realizing that this value should not be just left on the table for it to melt as the process goes on, but should be derived or should be protected upfront. And I would say this is only because of this, the residual cases are going into insolvency, which could not be resolved otherwise. Or if effectively prepacks deals that have been done and are being taken into insolvency as effective prepacks, not in the legal sense, but effectively prepacks are being taken into insolvency as well. And that is also resulting in maybe the actual companies going in insolvency not having the kind of value that they are have, and those values are being recovered much earlier. And which is great news also, that alternative resolution mechanisms are evolving. But even for those to continue, we still need a strong IBC, and IBC as a deterrent, a strong deterrent, is important. And therefore, some of these aspects that are being talked about over the yesterday and the next 2 or 3 days through these working paper series, group insolvency, cross-border insolvency, mediation, financial sector insolvency, pre-insolvency mechanisms, all of these are important for the law to evolve and to make IBC strong, even if it is not used. It's important to have that. And to that end, I think some of these research and discussions are very critical. And I can speak from an Insol India standpoint as well. We are committed to support activities and collaborate with activities like what Jindal Global Law School is doing, and make sure that we take this forward. And this is a step in the right direction. Thank you so much, Ishana. Back to you.
Thanks so much, Dinkar. So I would like to effectively kick off the first idea paper. The concept of this idea paper, hopefully my screen is visible. The concept of this idea paper is effectively to be able to develop the research as opposed to have pre-existing research to have commented on, particularly because these are two very specific areas, which is third-party funding and sovereign debt insolvency in the Asian context, particularly in the Indian context, which has very little data and assessment. And surprisingly, it has very many conversations around it, but for some reason, the discourse on it is very curated and very limited to case assessments and not really broad spectrum in terms of how regulation or law or external funding in the instance of this first idea paper can be introduced. So with that, I want to open the first idea paper, which is the third-party funding in insolvency. Now, in the context of third-party funding, like the title itself suggests, third-party meaning external, funding means money. And in the bird's eye context, I just want to look at the step chart that you see of insolvency in India. We have a pre-insolvency model. We recently, I think as recent as 2023, there was a pre-creditor-led, also known as fast-track insolvency, that the Insolvency Bankruptcy Board of India, which is the insolvency regulator, introduced. Now, previously, we've had, India has been very, very forward when it comes to restructuring regimes and lender forums, but the concern has always been capitalization and has predominantly been an assessment of how the group company complexities can be resolved. There have been many consortiums of banks that have stepped in at very early stages and asked the questions, including one of the biggest cases that we're going to talk about, which was an NPA resolution known as SR Steel. There were questions very early on how to effectively, through a consortium or through third-party interventions, be able to resolve the company's debt or the non-performing asset problem through restructuring. But that has not worked out on the ground of large amount of cash, non-agreement of, say, the founder, promoter, or the large equity shareholders and the board of directors, or because the operational complexity and the independence of the companies in that conglomerate are so high, which we are going to talk about as a part of this presentation as well. Now, I have written a big word because I am a professor. The concept of information asymmetry has effectively prevailed through the background of a lot of insolvency reform and a lot of commercial law resolution reform that we've seen in India, because resolution in general is an ex post measure, but we need ex ante, meaning we need regulation and law to be able to effectively sufficiently allow or disallow certain components, because by nature we have been a jurisdiction that require or sort of needs outlines, directions, guidelines, or legislation to be able to enact or implement, right? And sometimes our implementation is not entirely on point, despite the fact that the law is very clear. And that's something that I want to put forward in this presentation as well. Now, because of that, we've had a lot of situations of different accounting practices, different bookkeeping, non-information in terms of assets of companies, non-information in terms of claims that the companies has in terms of potential or existing litigation, and that effectively has been a problem in terms of implementing pre-workouts. And therefore, you've not really seen external buy-in when it comes to pre-insolvency, and a lot of creditor control, particularly secure creditor control, has been demonstrated alongside promoter control when it comes to understanding pre-insolvency. The second component is when you are in insolvency. So India's insolvency regime is a prima facie default-based trigger for insolvency with a default threshold. And during this particular default-based trigger threshold process, you have something called a moratorium period. You have something called a claims consolidation. The agenda was to reduce information asymmetry and also to allow for a going concern value maximized pocket in which a particular company which is in distress, owing to non-performing asset problems or owing to just prima facie default that has effectively happened maybe a week before the insolvency process is being commenced by an appropriate creditor, is when you are able to potentially introduce a concept of interim financing, meaning how is it that you can best find value in running a company as a going concern, turning that around, potentially assessing profits, which is why the case of SR Steel, which I want to talk about, which was billions of rupee in terms of distressed debt, which effectively had a profit turnaround during the insolvency process, and did see a lot of interim finance arrangements that became possible, and thus an interim finance model, which is already a part of the insolvency and bankruptcy code, which is the prevailing law in India, becomes sort of tantamount in understanding how external sort of buy-ins are also possible, or financing is also possible, in addition to a lot of inter-se arrangements, meaning during the insolvency process, a lot of side creditor workouts that are being seen, either owing to creating a strong hold in the insolvency process, or in the context of effectively finding their best recoveries as a part of the insolvency process, which is going to be the topic of the presentation. I do want to talk about the fact that there are 3 layers to it. after insolvency resolution, in which you have to find resolution as a liquidation model, you do have issues in terms of how you're going to raise financing. If you are trying to sell a particular company or trying to model a particular company into a split of assets or a strip of assets at the liquidation process. You're also looking at failures in insolvency resolution because you're looking at the cost of implementing a particular resolution in a distressed company being very high, for a lack of a better word. And that's the premise with which I want to make a case for third-party funding and see if at present our regime effectively makes a case against or not. Now, the idea paper effectively started out, as I mentioned, with the objectives of insolvency and the implementation model. I want to focus on the fact that interim financing in principle has been a benchmark and a hallmark concept that was introduced under our law, but there are excessive roadblocks that have been found, particularly because of the manner in which the interim financing model is being adopted in practice. I want to talk about the fact that interim finance, though very relevant, has now become a very non-viable sort of model because of the regulatory hurdles that the IBC has created. And I want to talk sort of implementation of the IBC and the interpretation of the IBC is created. And then I want to talk about the potential models that can be adopted to be able to strengthen the interim finance regime for third-party financing or raising any sort of external finance to run companies as going concerns in insolvency. Now, I want to split this particular paper into raising finance and then being able to return it, because the model that we need to effectively adopt predominantly is having the security of exit when you have entered a particular distressed market. So I want to split this raising interim finance into 3 stages. When a particular corporate debtor is being admitted into insolvency, when you have a creditors committee that is monitoring the manner in which you are able to value maximize that particular corporate debtor as a going concern, because I think one has to understand that insolvency resolution in India and creditor control go hand in hand, because it's an entirely commercial wisdom of creditors driven process. And then when a resolution for that company is being negotiated, this is a pre-liquidation resolution that I'm talking about. Subsequently, I want to also then talk about returning interim finance, because we have, even in the pre-regime, seen that perhaps getting someone to bid into a distressed business because they want to perhaps enter the market, which was previously barriered, is still a possibility. But exiting has been a problem in India, which is the ex post component. Resolution and exit of that particular financier or protections of that particular financier has been a concern. So during insolvency, if I'm able to raise a particular amount, what is the protection that I'm providing this interim financier? Am I giving a priority payout, or am I creating a situation where I'm going to provide in the resolution a method in which there is a profit or a return on investment that you allow for that particular financier, right? Which is at resolution or after resolution. At resolution, the insolvency resolution method of priority of payouts, and the IBC specifically provides for a cost payout, which is where the idea of interim finance also has been built in, where interim finance is actually insolvency process costs, and the law provides for it. So you pay that out in priority. But in that spectrum, you've seen, based on the limited information that is available, you've seen a lot of lender resistance to allow a third person to come in and get priority. And this is also a general concern which even founders have faced, where founders who have extended finance to their own company, which is large equity shareholders, who are suspended at the time of the insolvency process. Sorry, that's something I should have mentioned. The existing board of directors is suspended when an insolvency in India commences. And you have, in big insolvency cases, seen situations where they have been individuals that have extended finance, but that is before their entire rights have been excluded as a part of the insolvency process, which was the case of SR Steel. And I want to make a case for not having or not sticking to the letter of the law becoming a concern as to why companies are not in insolvency and not finding maximum value. Now, very quickly, in terms of where these law reforms started out, we wanted to ensure as a regime that there was viability in enterprise. We wanted to ensure that this was regulated strategic merger and acquisition or any other sort of form of resolution or restructuring that you could find. We as a regime wanted to ensure that it was a time-bound process to make value maximized method in which creditors in an insolvency process or even the corporate debtor in an insolvency process can have the best possible resolution, and ensure that it was a more negotiation-based, creditor protectionist focused and a company protectionist focused resolution process. Now, in that sort of spirit, there was a very important point that was repeated throughout the manner in which the reforms were proposed, which is to ensure that there was value to the going concern, which is value to the corporate debtor, and running it as a going concern would be done in the most external and the most comprehensive, cohesive fashion in two phases. The first phase would be with an insolvency professional at an interim stage, where he could be able to stabilize the company to ensure that the next step of resolution, when a creditor committee was being formed, when the creditors were in control, where claims were being settled, where antecedent transactions were effectively being evaluated, there was sort of a flat, not go down, not go up, but at least a flat line in which a company could run as going concern. The only sort of exclusion was that you can't encumber property when you're trying to raise interim finance. Now, as I've sort of extracted the provision of why this particular provision was provided, you effectively wanted to ensure that you would have a method in which you will be able to raise and stabilize finance and make sure that that particular finance was paid out upfront, and you did not need prior consent of the creditors as long as any of the properties of the company were not encumbered. Now, in this context, like I said, the return would entirely be in the manner in which the law already provided for, which is it would be costs and therefore would be returned upfront. And this is the first phase in which external finance could be raised. The second sort of phase in which finance could have been raised would be with, be it secured or unsecured, with the prior approval of the committee of creditors. And again, there is an explicit requirement to ensure full repayment of this particular finance as part of costs of insolvency resolution. Now, here I want to take a step back in the manner in which over time there have been restrictions that have been introduced into the law. So initially, when the law was being drafted, there was really no restriction in the manner in which resolution finance could be raised. It was a very US-UK combination model. You did not really want to effectively introduce any restrictions on the manner in which a company's debt could be restructured, which is why related parties or promoters could also, to an extent, come front with proposals to restructure the resolution plan. So this is effectively from the excerpts of the bill that proposed the provision of resolution in insolvency under the Insolvency and Bankruptcy Code, which included promoters of a debtor. Now, the concern over time has been very quickly thereafter, particularly because of the case of SR Steel, where the promoters of SR Steel, which is the founders or the large equity shareholders of SR Steel, had very quick put together a new company and were able to effectively figure out a financing method to reorganize the debt. Very quickly, you created as a legislation restrictions on the manner in which resolution could take place. Now, subsequently, the issue has become, because you placed restrictions on the manner in which financing can be raised, the issues have become completely practical because, like I said, the law entirely allows insolvency professional at two stages to be able to raise interim finance in the context of who can offer and why, because of the manner in which you are regulating how the resolutions and restructurings would play out, and you're entirely depending on a creditors committee to effectively say yes or no to the manner in which money is being raised to run the company as a going concern, and also sort of not allowing third-party financing because you don't want to change in priority of recoveries as a particular lender. You are looking at a lot of conflicting issues when it comes to raising finance and efficiently running companies as a going concern. Now, I want to effectively just end my presentation with certain sort of points that need to be addressed, and also make a case for third-party funding, because in practice that we're seeing, and a lot of cases that we're seeing, you're looking at third-party fundings through, say, asset reconstruction companies, or through inter-se arrangements between private equity funds and lenders, where you're able to sort of transition or transfer, say, voting rights to be able to allow market entry, but you're not really looking at just external interim finance being raised, because external parties are not allowed to enter the distressed company because of a lot of lender control or creditor committee control, or they are not assured an exit, meaning that they are not provided sufficient surety that they will be paid process costs at the end. Now, a few points that we need to sort of consider perhaps when we're talking about interim finance and third-party funding is that we, as a regime for the success of insolvency law in India, have to strengthen debt financing, have to effectively provide solutions for group complexities and ownerships. Even in SR Steel, the Supreme Court of India had made this observation that we should effectively see if connected companies have any value without a company that is gone into insolvency. We need to perhaps, as a measure in the group ownership and complexity in operations, consider third-party releases as a manner in which we could introduce interim finance, and as a measure in which we could introduce third-party funding. And lastly, one of the points that I want to leave this particular group for discussion with is the continuous issue of using insolvency methods of restructuring to reinforce corporate governance measures. Because at this point, when you have excluded boards of directors and promoters who have in the past, even in SR Steel, a large amount of interim financing was provided by the promoters of the company, who have effectively consistently shown some interest, but now no longer so, because you have excluded them to the extent that even resolution plans don't provide any kind of measures to them, even when they extend interim finance. You are effectively using an insolvency law as a tool to reinforce corporate governance, which might be problematic if you're trying to effectively restructure as opposed to provide for a very sort of recovery-oriented remedy, which an insolvency law is not supposed to do. So with that, I want to sort of close out my presentation and first invite Joe to sort of give an international perspective and provide his thoughts.
Thank you very much, Shannon. That was very educational. I'll just pull up some slides that I intend to use in responding to some of the points from the international perspective. So broadly speaking, I'll split it up into what the US position is, where the terminology or the equivalent for interim finance is really debtor in possession finance. And I'll also cover the concept of legal finance, which is sometimes referred to confusingly as third-party funding, which obviously got a different context to how it's been used in India, or litigation finance. But in relation to just DIP finance first, which is a familiar concept in the US, it really presents a crucial opportunity for distressed companies that would otherwise run out of cash and struggle to meet immediate financial obligations, including servicing debt, paying employees, covering rent, and covering other day-to-day operational costs. It arises where lenders may be willing to extend DIP financing to companies that might have strong creditworthiness in normal circumstances, because they are afforded unique lender protections that are not available outside of Chapter 11, and DIP financing falls under the bankruptcy code in the US under Chapter 11. These protections include the ability to prime existing liens, having the financing terms court approved to prevent further challenges by other creditors, and imposing strict controls on how borrowers utilize funds. The advantages of the debtor in securing DIP financing are evident. Creditors and lenders also have the strategic motives to offer to consent to such financing. And from an economic standpoint, DIP financing often carries higher interest rates and fees than what lenders could secure outside of Chapter 11 for similar loans. Furthermore, it represents a relatively secure investment because of the safeguards that are afforded under the bankruptcy code and the oversight of the bankruptcy court. Consequently, DIP financing is a relatively secure investment for those lenders who are interested in participating in it. Additionally, the debtor's existing pre-bankruptcy lenders frequently utilize the various mechanisms available to DIP lenders to safeguard their existing investments to the debtor. In some cases, they may even aim to acquire ownership of the reorganized entity post-emergence through participation in DIP financing. An understanding of the fundamentals of DIP financing and how the diverse and sometimes conflicting interests of the debtors, the DIP lenders, and creditors are managed within a Chapter 11 case provide valuable insight into the driving force of a reorganizing process in the US. For DIP financing in the US, it is regulated, as we said, by Chapter 11, the Bankruptcy Code, and to be specific, the section that we're looking at is Section 364 of the Code, establishing of DIP financing arrangements permitted by the debtor to secure credit after the filing of bankruptcy petitions. The section also serves as an incentive for both new and existing lenders to extend loans by affording them special protections. If the debtor requires unsecured debt outside the normal course of business while undergoing a Chapter 11 bankruptcy proceeding, it must seek approval from the bankruptcy court under Section 346B of the Bankruptcy Code. To incentivize lenders, known as DIP lenders, to provide unsecured financing to the debtor, the Bankruptcy Code grants DIP lenders administrative expenses priority under Section 503B. This priority ensures that a DIP lender's claim for repayment of unsecured DIP financing takes precedence over all other pre-petition unsecured claims, which must be fully paid in cash for the debtor to successfully exit bankruptcy unless an alternative agreement is reached with the lender. Often, a mere administrative expense priority is insufficient to motivate lenders to offer unsecured DIP financing. In such cases, if the debtor cannot secure unsecured financing, the bankruptcy court may authorize the debtor to obtain secured financing under Section 346 of the Bankruptcy Code. Under this section, the DIP lenders' DIP financing is granted as a super priority status over all other administrative expenses of the estate. Additionally, the lender receives a security interest in any unencumbered assets or a junior lien on assets that are already encumbered. Credit acquired under this section necessitates approval from the bankruptcy court, but also requires the debtor to demonstrate to the court that it could not obtain financing on an unsecured basis. If the debtor still cannot secure sufficient funding backed solely by previously unencumbered assets and a junior lien on already encumbered assets, it can seek secured financing under Section 364D. In this scenario, the debtor may propose a priming lien, which is a lien on collateral that takes precedence over existing pre-petition liens of the same collateral. This arrangement requires the DIP lender's claims to be satisfied before any claim by existing lenders secured by the same collateral, regardless of the source of payment, such as proceeds from the sale of common collateral. Financing under this Section 364D resembles financing under the previous section in that it is only available to the debtor if it can demonstrate to the bankruptcy court that without a priming lien, it could not otherwise have arranged such financing. The ability to offer a priming lien in previously unencumbered assets is exclusive to Chapter 11, and it's a primary reason why debtors can attract DIP financing in Chapter 11 when access to credit, even secured debt, was not available outside of bankruptcy. While the capacity to prime liens benefits DIP lenders, it also has significant implications for existing secured lenders, as priming liens impact the interests of these lenders. The Bankruptcy Code includes substantial protections for existing lenders whose liens are being primed. So if the debtor intends to prioritize existing liens, it must secure consent from the affected lenders or guarantee that their interests in the collateral are adequately safeguarded against any reduction in value due to the prioritization. Accordingly, under this section 361 of the Bankruptcy Code, adequate protection may include any of the following. 1, providing cash payments, a one-time or interval payment to creditors to compensate for loss in the value of the collateral, or establishing an additional or substitute lien to offset any decline in the collateral value. Or thirdly, granting other relief that ensures the creditor receives an amount equivalent to their interest in the collateral, which is considered indisputable. Existing lenders typically resist being pushed down the priority ladder and may dispute the adequacy of the protections offered. Since a contested prioritization can be complex, contentious, and destabilizing process for the business, debtors usually aim to avoid such disputes in the early stages of their case. They seek consent from existing lenders or negotiate with them to secure DIP financing. Consequently, the DIP financing that prioritizes existing liens is typically provided by those same existing lenders who also prime their own existing liens, as well as those of co-lenders who do not participate in the DIP financing. There are several other factors that make providing DIP financing appealing to lenders. Firstly, DIP financing can offer lenders relatively high interest rates compared to what they would receive outside of a Chapter 11. For instance, in 2019, the highest interest rate for DIP financing reached 20% in Chapter 11 cases like Remnant Oil and Generation Next franchise food brands. DIP financing serves as a means for existing lenders to protect the value of their existing loans to the company. In many instances, if the debtor were forced to liquidate hastily due to a lack of funds, these lenders would likely recover significantly less from their loans. DIP financing signals to vendors and customers that the debtor possesses the necessary capital to sustain operations during bankruptcy or execute an organized sale or liquidation process, thereby maximizing the recovery for existing lenders. Furthermore, existing secured lenders may choose to provide DIP financing as a defensive strategy to prevent external lenders from obtaining junior or prioritized liens on the collateral already securing their loans or senior liens on unencumbered assets. Given their existing investments in the company, existing lenders often prefer to maintain control by providing financing and shaping the direction and timelines of the Chapter 11 proceedings. They risk losing this control if a third-party lender steps in to offer DIP financing. In relation to legal finance, which is a separate category, but it often is used in the context of bankruptcy proceedings in the US, litigation finance, also called third-party funding, refers to a transaction in which litigation risk is valued and used to secure financing from a capital provider that is not a litigation party in exchange for a share of the future proceeds generated by the litigation risk. Funds are often provided on a non-recourse basis. If the litigation does not meet the agreed definition of success, the capital provider does not receive back its capital or a return on its investment. Non-recourse litigation finance is used to manage risk and improve creditor recoveries in bankruptcies that have significant litigation assets or litigation between creditor groups. Historically, bankruptcy stakeholders have relied on limited financing options, including releases by management, advisors, former equity holders, and other third parties that provide capital in return for those releases, contributions of capital from senior creditors as part of planned negotiations, or contingency fee agreements, fee deferrals, or further cash contributions from out of money creditors. But these solutions have their limitations and can result in a bankruptcy stakeholders releasing claims for less than they're worth or foregoing them altogether. Legal finance allows estates to pursue valuable claims that otherwise may have been abandoned or settled, which increase creditor recoveries. Legal finance can come in various forms. Firstly, companies reorganizing in Chapter 11 can finance or monetize claims. So such companies often have an outstanding high-value claim or a basket of claims. Although these Chapter 11 companies may obtain DIP financing, and they typically prefer to use DIP financing capital for funding operations and not pursuing litigation that is non-core to the business and has substantial risks of to return of investment. Instead, companies may choose to partner with a legal financier provider to obtain non-recourse legal finance to preserve DIP cash. This may limit risk or generate additional operation cash through the outright monetization of a claim. Or secondly, funding liquidations or litigation trusts. A funder can provide non-recourse capital to cash-strapped estates and trusts that have litigation assets, potentially allowing for a faster and larger recovery to the estate and creditors. Creditors may also prefer to seek funding for litigation trusts so that any existing cash can be reserved to guarantee creditor recoveries. With increased resources, an estate can decide to launch a broad litigation strategy that can accelerate the timing of creditor recovery. Or finally, providing capital such as that for inter-creditor disputes. If a bankruptcy estate involves senior and subordinated creditors, this agreement may arise over their respective priority. Creditor groups can use the cash injection and non-recourse capital to challenge a lien or seek to remove priority without assuming additional risk. For example, the Motor Liquidation Company Avoidance Action Trust obtaining litigation funding with court approval to fund litigation challenging the priority of secured creditors in the old GM case. So one or two examples perhaps of how litigation finance has been used in a bankruptcy case. A good example would be that of MagCorp. For more than a decade, the bankruptcy trustee in Magnesium Corporation of America and the Trustees Council pursued claims against MagCorp's former holding company for placing MagCorp into bankruptcy. In 2016, having won $213 million judgment for the benefit of MagCorp's creditors, the trustee felt confident that MagCorp was likely to successfully defend the judgment on appeal and collect the judgment. However, after litigating the matter for 13 years, the trustee did not have sufficient funds to litigate the matter if there was to be a retrial, was concerned with the risks of a negative appellate outcome to creditor recoveries. So to address this risk and ensure that there were adequate funds to litigate, the trustees obtained litigation financing by arranging for the public auction sale of an interest in the right to receive proceeds from the judgment on appeal. This was approved by the court under the Chapter 11 relevant sections. So that's just, I suppose, a good place to stop in relation to how legal finance is used in the bankruptcy context, which sits side by side with DIP financing in the US as well. I think I'll hand over to Dinkar for some of his comments.
Thank you so much, Joe. Over to you, Dinkar.
Thank you, Joe. Thanks, Ishana. When I look at interim finance or third-party funding from in the Indian context, and taking on from what Ishana had said earlier, I would, it's actually a bit funny. I would say that in the pre-insolvency context, where resolutions are being done under the RBI circular or bilaterally or through one-time settlements, in that context, there is a lot of third-party funding happening, but it doesn't have any legal sanctity. And in the insolvency context, where you have all the legal sanctity, but there isn't much interim finance or third-party funding happening. And that's the reality in the Indian context over the last 4 or 5 years or so. Why is that? In the first instance, where as we see in the last few years, a lot of resolutions are happening pre-insolvency, either through the RBI circular or through ARCs buying out these loans, or through one-time settlements. There is a fair bit of private credit, billions of dollars of them, as I was saying earlier, coming into the system to bail these companies out, because at that point in time, and this is pretty easy. This is pretty. The earlier in the process you find a resolution to the asset, there is more value there. So the earlier you find stress and resolve for it, there's more value there. So when you see more value when you earlier in the process, when a company is seeing stress early, there are people willing to fund it because they know that there is enough there and they'll get that money back. And the lenders are also willing to let that money come in. But unfortunately, while there is no legal precedence, if those companies go into insolvency, that money can't stand on top of the other lenders, unfortunately, as it stands today. But there are commercial ways to find priority for those, either through securing it against a particular sponsor-owned asset or an asset that's not currently secured, or against the cash flows. So, but suffice to say that enough of that is happening. I would just say that pre-insolvency third-party funding, if we can get that aligned to the June 7th RBI circular, and say once the ICA is signed, the intercreditor agreement is signed by more than 75% of the lenders, that they will not take any insolvency action. At that point in time, I think if the lenders can also introduce an interim finance equivalent clause, then that will help give some legal sanctity to that as well in pre-insolvency situations. But otherwise, it seems to be working well. And as later I'll talk about how the pre-insolvency resolution mechanisms are merging into the insolvency mechanisms through the proposed pre-pack resolutions, and it can be a good bridge there. But I'll hold on to that. Moving on to the insolvency situation, I think in realistically, if the interim finance is viable commercially and there is top security to that, it's the highest level of security, then it should be easy to avail of interim finance theoretically. But practically, it's not happening as much. Why is that? Because when you say commercial viability, it means that will the interim finance help in protecting value of the company, of the corporate debtor as a going concern? Number one. And number two, will the interim finance not just protect value, but enhance value of the going concern during insolvency? I think both these questions, or either of these questions, need to be answered, and not the RP or the resolution professional in the first place, given all of the information asymmetries that Ishana spoke about, all of the lack of data and the lack of personnel. Given all of that, the resolution professional needs to be convinced that interim finance is needed to either protect value or enhance value. Then he needs to take this conviction and convince the committee of creditors, the majority of the committee of creditors, that this is certainly the case, backed up by data and by analysis, and say that this is not good money being thrown behind bad money. And then thirdly, the committee, the individuals in the committee of creditors who attend these meetings need to convince their hierarchy on top, who will need to approve any of such interim finance to be given to CDs to make that happen. And all of that, unfortunately, needs a lot of conviction and needs a lot of time as well. And historically, I mean, unless it's a slam dunk kind of a case, which Ishana spoke about, or there are, I would say, maybe a handful of situations in all of the maybe 2,600 odd resolutions, there would probably be, I'm just saying anecdotally, could be about less than 25, 30 of them where interim finance has been availed and been used to protect value or enhance value. But practically, either the RP doesn't have the data or the conviction to do that, or it gets mired into the decision-making of the committee of creditors that why should we put in more money in this company, which already is in insolvency, and we may not even realize that. So that's where I guess, and the other aspect which has muddled this up even more is that when all of this analysis is done, you assume that this X amount of interim finance is needed to keep the company running for 180 days, 270 days, or 330 days. But if these insolvencies run for 540 days or 720 days, then obviously all of those calculations go out of the window. So the lack of that certainty of how long will this money last and how long will the interim finance be enough to keep this company running as a going concern has also been a deterrent in making this happen in some of these cases. And I would say the last deterrent has also been that recent regulation, about maybe 2 or 3 years back, it came that interest on interim finance during liquidation will be limited only to the first 12 months. The interest on interim finance will not be paid for more than a 12-month period if it goes into liquidation. I think that's also put in a little bit of an uncertainty into this whole into the mix as far as the interim finance is concerned. So because of that, I think unless it's absolutely clear that such money will come in and can be paid out of the cash flows of the business without impacting the recovery to the creditors, it has not unfortunately gone forward. But I think as with everything, the market participants are evolving. The RPs are becoming more aware that if they do this, and it also depends. I mean, from a reputation of the RP standpoint, while if he believes that he can deliver this thing and he's actually returned interim finance historically from the cash flows of the business, then I guess the ability of the creditors to believe him the next time he goes for interim finance increases significantly. So that's also helping. The creditors are also becoming, I would say, more sector oriented, more commercial in their thought process, and are thinking on the lines of interim finance. And there's never been any dearth of money. There's never been any dearth of third-party money for interim finance. It's some of these factors that I mentioned, which is impeding that in a way. So I would say, I mean, in terms of going forward, some of the structural things are there, but if legally, as the prepackaged resolutions are being talked about, if we can, and there is a potential bidder who comes in early into the process, even pre-insolvency, and if interim finance can be looked at from such bidders who are in the prepackaged insolvencies even before the process starts, and those can continue into the insolvency process to help protect value. And secondly, I would say in pre-insolvency processes, along with the ICA, as I mentioned earlier, if interim finance could be given the status of interim finance in insolvency, that will also go a long way in terms of protecting value in these situations. So yeah, I mean, Ishana, I will probably just have about 10 minutes for Q&A. We can pick that up.
So, Dinkar, thanks so much. I think when we put this together, I was telling you that we could probably spend a day talking about just this topic, and a lot of food for thought on both points. But I want to just kickstart the conversation on the issue of raising the best way to sort of raise finance in insolvency for a going concern. Now, Joe, I want to start with you in terms of any thoughts on what are the kind of exit rights that you contractually effectively agree to as someone who finances a lot of companies that are potentially in distress, not just from a litigation finance perspective, but a combination interim litigation finance perspective.
Yeah, so I suppose in our mindset, the thought really is that we're last money in when we've seen everything, and we need to be first money out. And how that is reflected in terms of security will depend on each individual jurisdiction. In the UAE, where I'm from, the bankruptcy code has a provision so that the bankruptcy trustee can take on the likes of legal finance if it is to assist in gathering funds into the business. So a lot of the kind of businesses that you look at are, usually in the construction sector, and their assets tend to be just receivables on projects. They're not actually asset heavy when it comes to stuff with real collateral. They don't tend to own the buildings even that they operate out of. They might have a few cranes, but they're often quite on hire as well. So those actual receivables that are due to them, we would be looking for some sort of security potential or assurances that the bankruptcy trustee would pay from those receivables to us first. And how that is reflected depends on the bankruptcy code, but certainly under Chapter 11 in the US, you can achieve that. You can achieve it in the UAE. It needs to have court approval in that place as well. And that can be assisted if you do have actual, deeds of assignment or some sort of lien or whatever the actual security in the relevant jurisdiction is. So really what you're thinking about is that you want to be first dollar out above everybody else, not even on a pari passu level. That tends to be the kind of mindset when it comes to a third-party funder such as ourselves. Obviously, banks who are already exposed may look for similar types of security on new money that is going in, so that at least it ranks priority above all others. But that's tend to be the kind of mindset that anybody in the finance business thinks about.
Okay, Dinkar, just sort of with that question, I wanted to add a question for you. How relevant is strengthening the related party financing measures when you're running a company as a going concern? Do you think from a law perspective that needs to be sort of re-looked at, and the barriers that have been created in raising such sort of interim finance, does that sort of need to be re-looked at for us to be a more external finance oriented regime in the insolvency space?
That's a good question, and I think on that topic we can probably spend hours debating the fact that whether 29A should be there or not there in terms of, and that's when you talk about related parties being unincentivized because of the introduction of Section 29A. I mean, I firmly believe that Section 29A was introduced for a purpose back then, which, and just for the benefit of the larger audience, there's the Indian law at that point in time precluded the sponsors or the current owners of the business to come back and bid for their own business in insolvency if they were NPAs or if they were non-performing loans for more than a year or for various other reasons that were stated, and therefore they were not incentivized in any way to support the resolution process in any way. But I think those were probably needed at that point in time for larger cases where there was doubts about mismanagement and embezzlement and all of that. But today, the cases that we're seeing, or the corporate debtors that we're seeing, largely are businesses which are mid to small in size, and there isn't enough public information available on these businesses. There is a lot of information asymmetry on these businesses, and the best people who know these businesses are the promoters or the sponsors of these businesses. So it will not, I don't think it'll be a bad idea to allow these and if the larger objective is to protect value and to maximize value, then under the insolvency process, under the aegis of the COC and the RP, if the promoter is willing to put in money to protect value and keep the business running as a going concern, I think it serves all purposes and should be encouraged, in my view, Shana.
Thanks so much. We actually have a very interesting question on guarantee obligation buyouts. Now, Joe, just from your experience, I want to understand how that works. And Dinkar, from a practice perspective, have you sort of seen where guarantor obligations have been effectively transferred through contract during an insolvency resolution process?
Yeah. Thanks, Ashana. Yeah, it very much depends on the jurisdiction that you're dealing with. I mean, we've been involved in the acquisition, outright assignment of personal guarantees from banks in the Middle East, where the underlying asset is really the potential to litigate against promoters who have maybe embezzled monies or just haven't paid back the guarantee and have, hidden their money in offshore jurisdictions. So situations like that in certain countries are pretty straightforward. In other jurisdictions, such as Saudi Arabia, once there is a bankruptcy regime in process, that actually puts a moratorium on everything, and that includes the ability to pursue guarantors. So that's obviously tricky in our line of business because we wouldn't want to put money into a situation that could be suspended in the bankruptcy process for several years if we cannot just pursue the guarantee on a unilateral basis. The type of things that financiers are looking at, obviously, when it comes to guarantees is what assets do the promoters ultimately have. If you look at a market the size of India and you look at, let's say, situations where banks haven't been able to recover against assets within the country that the business has itself, then they're looking outside of the jurisdiction. It's an expensive process to take an asset tracers to apply for 1782 discovery in the US to see dollar movements and the types of things that would suggest where the ultimate prize is in pursuing personal guarantees. But it's certainly an active area of what people like us do. Quite often the litigation is in offshore jurisdictions. So we're just dealing with, common law type of familiar context in those places. And when it comes to in the acquisition side of it, it really comes down to whether or not there's anything regulatory wise in India that would prevent that. Sometimes if you can't acquire it because there's difficulty in banks in terms of selling it, they'll often have provisioned it down to very little, so it might not be worth an awful lot in their balance sheet, but they may prefer just a partner whereby legal financiers like us will cover the cost of litigation, and then we just agree on what the split is on a recovery in the end on taking action on that guarantee.
I would say I would split this into personal guarantees and corporate guarantees, right? In terms of guarantor obligations, the ability to enforce personal guarantees and recover from that is still work in progress in India, as we all know. The evolution of the insolvency and bankruptcy code has been much faster, but I think the evolution on the personal insolvency and the recovery of the personal guarantees has been rather slow because of just the number of cases and lack of progress on those cases in there. But I mean, the law still says that yes, those can be brought in and those can be recovered as part of the process. So we just still need to see how it can be implemented better. But I think the bigger value is there in the corporate guarantees and the guarantor obligations around that need to be looked at. From, I think one of the topics that you had in your sessions is the group insolvency as well, because most of the larger businesses, mid to large businesses in India operate as group, multiple entities. There are cross guarantees, and each of these the businesses are interlinked. So I would say we need to find a more effective mechanism for group insolvency to work, so that we can make sure that the value for all of the stakeholders is protected through a group insolvency process, and all of these guarantees are effectively brought to bear, rather than multiple different insolvencies and multiple different processes going on in different courts. And that again is work in progress, but I know it's been taken up very seriously by both people who are researching on the law as well as by the legislature as well. So hopefully we'll see something soon around that.
We actually have a great parting short question. Should third-party funding in insolvency be legislated in India? So we can perhaps do a yes and no, and lessons from other regimes, and close out. What do you think, Joe?
I wonder if the question is referring, when they say third-party funding and insolvency, if they're talking about legal finance. We call it third-party funding as well, because it's a bit of a hot potato at the moment in terms of the Supreme Court decision coming out of the UK and the PACCAR decision. And my take on it is that if some light regulation can be good from time to time, if you over-regulate, what you tend to do is take out competition, and there'll be very few players that may be able to actually participate. I mean, if you put minimal capital requirements in place, for example, for legal financiers, what you're going to find is that there's not that many of them in the industry in the first place. And, people who are ready to finance and they've got capital available may not be prepared to do so. So you're really trying to balance regulation with actually encouraging enterprise and encouraging people to come up with funds to give ultimately access to justice, to allow claimants access monies that otherwise they may not have had available to them. So it's a bit of a balancing exercise. I mean, certain jurisdictions have done it quite well. I think that Hong Kong and Singapore, with their recent legislation, works. Ireland has draft legislation before the lower house at the moment, which would be enacted pretty soon. So it's really getting the right level of legislation. But if you over legislate, you effectively take out a lot of potential financiers.
I mean, from my perspective, litigation funding is very, very minimal today in India. But I believe if there is value, then it will be there. I mean, the money will find a way to to fund it and extract that value. So legislation should be there to give an overall. I agree with Joseph on that, is to give an overall protection for all stakeholders. But I think this is a commercial aspect, and if there is value, then litigation funding will help in extracting that value.
So much for that positive note, Dinkar. A lot of food for thought in terms of an idea paper from our first session. And I want to thank Burford Capital and Joe Durkin for the time that has been spent in providing some thoughts on how India can take it forward. And Dinkar Venkat Subramaniam as not just the EY India partner and the national leader for debt and special situations for this panel, but also as the president designate of Insol India to be able to collaborate and allow for these ideas to sort of flow. With that, we will flow into the second idea of sovereign debt. And I would like to invite the second panel, which is of Akshaya Kamalnath, Charles Mark, and Gausia Shaikh, and thank the two of you for such a riveting session. Thank you very much.
Thank you, Shannon. Thank you, Dinkar.
So we have the second panel, which is on CAC in strengthening CAC index. Just give me a second. There seems to be a concern on co-host. Could I please request IT to check on why panelists are unable to start their videos? All right, great. Thank you so much. Thank you so much. So I'm going to re-invite the panel again. Good afternoon, everybody. Our second panel today is on building a CAC strength index for sovereign debt restructurings. We have, once again, a collaboration here with Red Intelligence, and the author of the paper is Gausia Shaikh, who's a legal analyst with Red Intelligence. I'm extremely grateful for our return board of editor and board of advisor, Akshaya Kamalnath, who's an associate professor with ANU, and also serves on the board of directors of the Insolvency Law Working Paper Series. I'm actually quite excited to introduce the second sort of responder. It's Charles Mark, who's a lecturer in law at Robert Gordon University, and predominantly because of the wealth of work that Charles has done in this particular space and building research in this particular space. So this is going to be quite an exciting panel to effectively ideate on. With that, and without further ado, I'm going to invite Gausia to present her paper and then ask for panel response.
Thank you. Thanks, Ashana. I'm very happy to be participating and presenting this idea pretty much for the first time on a public platform. So I'll just try and share my screen, and please let me know if it's working. Can you see my screen, and am I still audible? Yes. So we heard Professor Paulus yesterday talk about how sovereign debt has increased exponentially in the past few years. And we've also been looking at the market and how there have been many sovereigns in the past few years, which are either at the brink of a sovereign debt restructuring or are at some stage of a sovereign debt restructuring, have either been successful at it or have entirely failed because they did not get the requisite bondholder approval for such a restructuring. So now whenever a sovereign debt restructuring comes into play, the first thing that you do is look at the bond documentation to look at something called a collective action clause, which is a CAC that I will be referring to as a CAC. So the first step is always to look at the CAC, and what the Red Intelligence CAC Strength Index does is that it assesses the strength of a CAC as strong or weak. But before going on to what exactly the index talks about, let's just look at CACs generally. Now, what is a collective action clause? A collective action clause in sovereign bond documents is a clause which allows the sovereign issuer to get a majority approval from the bondholders in a bond series for a restructuring exercise to be approved by them. So prior to the introduction of collective action clauses, you required unanimous voting from bondholders to take that step of either changing the date of the payment or for changing the principal amount or any delays in the interest payment. All of these decisions required every bondholder to approve the decision. So what that led to is that even a single bondholder could derail the entire restructuring. Also, a lot of times what happened was that such a bondholder would initiate some sort of litigation and get a better deal than the other bondholders if a restructuring does go through without that bondholder. So it is to deal with this that CACs came into place, where you now have a majority of the bondholders, their percentages are defined, and these bondholders make a decision which then binds every bondholder. So you can look at it as a sort of democratic process in deciding whether a sovereign issuer should go through a restructuring or not. So that in essence is what CACs do. But now over the years, we realized that while this was a great step forward, it's not enough. It is possible that of say the 10 bond series that a sovereign debt issuer has, one bond series does not really get the requisite favorable votes and a restructuring gets thwarted, or there's an obstacle in the restructuring because of that. So you had the development of various kinds of voting mechanisms under CACs. So the first kind, of course, is the single series voting, where you have a single bond series. You need, say, 75% of the bondholders to approve it, and it goes through. There's a second kind of single series voting, which involves quorum-based voting. So you have one level, which is where you require a set percentage to approve the extraordinary resolution for approving a debt restructuring proposal. And then there's a second layer where you say that, and at a meeting where you are making this decision, you need to have X percentage of people, of the bondholders present and voting. So that's an added layer of complication in the single series voting. Then we come to a stage where, to fill that lacuna of what happens when you get approval for some bond series, but you do not get it for the others. So you had something called multiple series aggregation developed. And there are two kinds of voting mechanisms within multiple series aggregation, and that is two-limb voting and single-limb voting. Let's just look at these two in a little detail. So what happens in the two-limb voting system is that you have two limbs or two stages of approval. So one is when you aggregate all the bond series and you obtain a favorable majority from that aggregated set of bondholders. And as a second step, you also need a favorable majority from bondholders of each bond series. So while it does allow you to aggregate bond series and make it a little easier for you to widen the pool of voters to make sure that you reach a favorable vote, there is an added step involved where there are two layers to the voting process itself. What single-limb voting does is that it looks at all the bond series and pulls them together into one large pool, and then you seek one vote from this pool in bondholder meeting. However, there are some conditions that apply to this. So for bond series to be aggregated in such a manner that they can form this uniform pool of bonds, the outcome of the bond, the outcome of the restructuring is what is important here. So if you are offering the same bond terms for the same new instrument that you propose at the end of the restructuring, then you can use single limb voting. Or if you use a new instrument that will be exchanged for the existing bonds, which is from an identical menu of instruments. It need not be the same instrument across all the bond series, but it's from the same set of instruments that are available that you are proposing. So as long as you have these conditions and you comply with them, you can use single limb voting, which is pretty much the ideal mechanism. Now let's talk about the Red Intelligence CAC Strength Index. Now, what does the index do? First of all, in terms of geography, the focus of the index is on emerging markets in Europe, Asia, Middle East, and Africa. We look at international sovereign bonds that have been issued by sovereign issuers from these regions. And when we talk about the strength of CACs, we are looking at it from the sovereign issuer's perspective. So when you say that a CAC is strong, it means that it might be easier for the sovereign issuer to go through a restructuring process, that it might be smoother than it would have been for others. So what we do is we categorize the CACs after reading the bond documentation as strong or weak. A strong CAC means that there is a less likelihood of holdouts. A weak CAC would correspondingly imply that there is a likelihood of holdouts from bondholders, and there's a higher possibility that the restructuring might not go through as smoothly. So what the index does overall is that it provides some basic information about the sovereign bond issuance, and it categorizes the CACs as strong and weak and gives you a preliminary picture of what might happen in the case of a restructuring at a future point in time. Now, how did we come about with the index? First of all, the aim was always to keep it objective. I did not want it to have any opinions or to be subjective in any form to make it vague in the sense of the categorization. So there was a very basic principle that I followed, which is that if the CAC allows for aggregation, it is a strong CAC. And if it does not allow for aggregation, then it is a weak CAC. Within the strong CACs also, the ideal, as I mentioned, would be a CAC which allows for single limb voting, where you have one large pool of bond series, where you can just basically drown out the holdout bondholders by seeking that one majority over a wide number of people or bondholders. For this process, I also had the guidance of certain model clauses that were released in 2014 by the International Capital Markets Association. The association had released model clauses for sovereign bond documents issued under New York law and under English law, which are two of the most popular governing laws when it comes to international sovereign bonds. So that is how the index came about. But why create this index at all? Now, every bond effectively denotes a contract. And if you want to know what, as lawyers, we understand that if anything needs to be done with respect to any transaction which has a contract behind it, the first place to start is to look at the documentation. But having reviewed 20 odd sovereign issuers and their bond documents, I can safely say that these bond documentations go into hundreds of pages and are just filled with legal jargon. So if an ordinary man or a layman, as we call, is to look at this documentation, they would have an issue that the Reddit world would call as TLDR, which is too long, didn't read. So in a way, the index tries to combat this issue of TLDR. So I do all the groundwork of reading and going through the bond documentation, and I categorize the CACs for you and give you a preliminary picture of what the CAC says. And that in effect gives you some level of predictability when thinking of how a particular bond might fare in a sovereign debt restructuring. In the process of the development of the index, I've engaged and spoken to lawyers, law firms, consultants, bondholders. And there is a use case for the index because every person, when thinking about a sovereign bond restructuring, or even just wanting to assess its rights when it comes to a sovereign debt restructuring in the future, has to look at some aspect of the bond documentation, and the most important aspect being a CAC. And of course, as the gathering here is, we are all people who are interested in the sovereign debt market. And so the index also has some use in the research and the academic world as well, and for any person really who is following the market in general. Now, what are the observations that I've made so far when making these categorizations of CACs? So having reviewed 20 sovereign issuers and their international sovereign bonds, I find that despite the fact that in 2014, you had the ICMA give you standard clauses to use, and all of this history and precedent of seeing how it's better to have CACs in documents and what the ideal CAC might be, weak CACs still exist. For example, Sri Lanka has a couple of bonds which were issued after 2014, which still contain single series voting mechanism in their CACs, and which are your weak CACs. Not just that, even unanimous voting has not really left the picture, because there are certain bonds that are issued by Turkey, which still require unanimous voting. So you still require that 100% vote from every bondholder in that case. Now, when you look at the weak bonds as well, there are some instances where the bonds are made even weaker just by the bond terms. For example, Pakistan has bonds which will mature next year, and they require single series voting, which makes it a weak CAC. They also require quorum-based voting, which adds another layer of complications. And then there's the third layer of complication that the bond documentation contains, which is that the quorum is 90%, which is a really high threshold. So having such a high threshold in a way sort of incentivizes bondholders to, take that 10% position and thwart a restructuring at that stage. So you've just taken a weak CAC and you've made it weaker. Now, this is entire discussion so far, I've spoken only about conventional bonds, but there is something called a sukuk, which is also a popular capital raising instrument. And in a way, over time, sukuk have come to mirror conventional bonds. But the difference is that a sukuk is a capital raising instrument, which is a form of an Islamic finance instrument. So it also requires some compliance with Islamic religious law and Islamic jurisprudence. Now, over the years, bond documentation and sukuk documentation, when reviewed together, we find that sukuk documentation has come to mirror a lot of clauses which are present in sovereign bond documents as well. And they do have CACs. And I have reviewed the CACs of sukuk from Pakistan, Maldives, Saudi Arabia, Malaysia, and I find that they do actually have strong CACs, which not only allow for aggregation across sukuk, but also across bond series. But there is a catch. The catch is that we have not seen a sukuk restructuring from a sovereign as yet. There is no precedent. So there is that level of uncertainty and lack of clarity in knowing what will actually happen in a sukuk restructuring, despite knowing whether its CAC is strong or weak. Now, having built the index, I can safely say that it is a first of its kind index. I have not seen such an index in the market or in academic research so far. But there is a sense of awareness that a CAC is not the end all and be all when it comes to any sense of predictability in sovereign debt restructurings, because a lot of other factors also come into play. For instance, there are political scenarios that come into play. Then you have debt policies of sovereigns that also come into play. And not just that, even other bond terms could affect the CACs in such a way and that it has an effect on the restructuring. For instance, Ghana has bonds which will mature in 2030, which have a guarantee from, which are partially guaranteed by the World Bank's IDA, the International Development Association. And they require that if a restructuring decision is to take place, you first need to take the permission of the IDA for such a restructuring. So even before you can go to the bondholders and use the CACs, you first need to go to the IDA and get their permission on initiating a restructuring proposal. So I'm very self-aware that this index does not do everything, but I believe that it is a good start. So thank you.
Thanks so much for that, Gosia. I would now like to invite Charles to give his thoughts as a response to your paper.
Oh, thank you very much. Good afternoon, everyone. I would like to extend my gratitude to Gosia for her innovative paper and presentation on collective action clauses to CACs in sovereign bonds restructurings. So I can see that this paper is making significant contributions to our understanding of the complexities involved in sovereign bonds restructurings, particularly through the introductions of a CAC strength index, which is the first of its kind. So this index will, I think, will serve as a novel tool for assessing the ease of restructuring proposal, thereby offering a form of financial democracy in what can often be continuous process. So I can see as the objective of my discussion today to critically evaluate the paper's methodology, findings, and implications. So I aim to provide a balanced critique and acknowledge the paper's strength, while also exploring some areas that might benefit from further academic scrutiny. So let's start from the overview of the paper. This is my understanding of the paper. So you can see the paper's central focus is on CACs, which are the contractual provisions in sovereign debt restructurings and sovereign debt agreement designed to facilitate debt restructuring. So these clauses have evolved from requiring unanimous consents to more democratic majority-based voting mechanisms, thereby mitigating the risk of holdout. Those bondholders who resist restructuring to seek better terms. So the paper's most innovative contributions is the introductions of a CAC strength index. So this index categorizes CACs as either strong or weak based on their efficacy in facilitating debt restructuring. The index is particularly focused on bonds issued by emerging markets across Asia, Europe, and Middle East, and Africa. So I can see it have scrutinized different voting mechanisms permitted under the CAC, such as the single series voting and multi-series aggregations, and evaluate them based on their ability to ease the approval of a restructuring proposal. So in the sense, this paper not only provides a comprehensive analysis of the evolutions and current state of CACs, but also introduces a novel tool that could serve as a preliminary guide for sovereign debtors, the creditors, and the policy makers. So turning our attention to the methodology employed in the paper, we cannot overlook the empirical analysis based on the data set of 23 sovereign debt restructuring involving 418 bonds issued by 16 countries. So I can see this foundation lends a degree of robustness to the study, particularly in this endeavor to assess the effectiveness of the CACs in mitigating holdout risk. So the data set allows for more in-depth and analysis understanding of how different forms of CACs, be a single series voting or multi-series aggregations, impact the likelihood of the successful bond restructurings. However, while the empirical approach is really good, we should maybe need to scrutinize the objectivity in categorizing CACs as strong or weak. So the paper utilized the ease of restructuring proposal approval process as a preliminary primary metric for these categorizations. And this is a logical starting point. The categorizations could benefit from a multi-dimensional approach that consider other variables, such as the legal frameworks within which these bonds operate, or the historical track record of the sovereign issues in questions. So more comprehensive categorizations could offer a richer understanding of what truly constitutes strength or weaknesses in the context of CACs. And more questions arise concerning the sample size and the geographical scope of the study. So the data sets comprise 23 sovereign debt restructurings from 16 countries, which, although is diverse, may not be sufficiently representative. For example, the paper focused on emerging markets in Asia, Europe, and Middle East, and Africa. And I got a question. So what about Latin American countries which have a rich history of sovereign debt restructuring, like Argentina, or developed countries where the dynamic of sovereign debt might differ considerably? So maybe perhaps in the future, you can expand the geographical scope and increase the sample, which might enhance the generability, the more reliable of the findings, thereby making the CAC strength index a more universally applicable choice. So turning now to the strength of your paper, I can see there's a lot of effort has been done in addressing the intricate complexity of sovereign bonds restructurings. So the paper has navigated through the world of CACs with remarkable clarity. So by doing so, it provides invaluable insight into the subject matter that is not only legally intricate, but also with the economic and political implications, so which is a really good thing, and especially given the more comprehensive research in this specific area. Another aspect of the paper is the introduction of the CAC strength index. Though it might need some improvement, this index serves as a really good tool for us as a researcher to assessing the ease of which sovereign bonds restructuring can be executed. And by categorizing as either strong or weak, this index provides a more comprehensive understanding of the restructuring landscape, which provides a practical party for sovereign issuers, bondholders, and researcher. And also, this paper makes a significant contributions to understanding of the role of CACs in the mitigating holdout risk. And also, I can see this paper is innovative methodological approach and insightful findings on the role of CACs. So these strengths collectively elevate the paper's academic and practical relevance, which is noteworthy to additions to the existing body of literature on sovereign debt restructurings. And I got some areas of improvement and some further questions about the papers. First is regarding the moral hazard and the CACs. Firstly, the paper addressed the complexity surrounding CACs, yet its treatment of the moral hazards associated with the CACs appears somewhat cursory. While the papers does acknowledge the potential for sovereign borrowers to overborrow due to the simplifications of the restructuring process, it does not dig deep into the long-term implications of this moral hazard. Could the inclusion of the CACs in adequately intensive reckless borrowing behavior, thereby maybe affect the financial instability that's aimed to mitigate? The second question is about the understanding of strength and weaknesses. This paper introduced the CAC strength index, which categorizing CACs as either strong or weak. As mentioned, I think it's a really good thing. It's a really good starting point, but it might be benefits from a more comprehensive understanding. For example, could a strong CAC in a politically unstable country be less effective than a weak CAC in a country with a robust legal institutions like London and New York, those countries who are the predominant governing law for the sovereign debt contracts? And the paper might consider a multi-dimensional approach to evaluating the strength of the CACs. And the third question is regarding the treatment of the Sukuk and Islamic finance rules. And I can see in your presentation in your paper, you have briefly mentioned the inclusion of CACs in Sukuk. which is an Islamic financial instrument. However, it does not explore the complexities of aligning CACs with Islamic jurisprudence, given that Islamic finance is a growing market for sovereign debt market, and especially in emerging economies. A more detailed analysis of how CACs fit within the framework of Islamic finance could enrich the paper's scope or the index scope and applicability. And the fourth question is about the inclusion of political and economic variables. And the paper could enhance by considering the broader political and economic variables that influence the effectiveness of CACs. For example, how do international sanctions, political stability, or economic cycle affect the operation of efficiency of CACs? Perhaps we can consider Russia as the sanction of Russia as a current example. And these variables could be integrated into the CAC strength index to provide a more holistic understanding of the factors affecting the sovereign bonds restructurings. And I can see this paper has a lot of implications for different people. For example, for the policymakers, this paper findings underscore the necessity for them to carefully consider the design of CACs in sovereign bonds issuance. The introductions of the CAC strength index will be a valuable tool for them to assessing the ease of restructuring. Will help them to formulate a more robust financial regulation in the future. I can see for the future, for future research impacts on borrowing cost. One of the future research that could be investigated, which is the correlations between the strength of CACs and the borrowing cost for sovereign issuers. I can see the paper has cited the IMF 2020 working paper that finds enhanced CACs are associated with a lower borrowing cost. Maybe a more comprehensive study could offer further insight through the usage of the index and the role of the international organizations. And I can see the paper had mentioned the international capital markets, the ICMA standard forms of CACs. Maybe more future research could move to conduct on how international organizations like the ICMA influence the adoptions and the effectiveness of CACs globally. And also you can mention about Paris Club as well. Comparative analysis can also be done. For example, like a comparative analysis of the CACs in conventional bonds and so-called. Given that circle must comply with Islamic finance rules, it could be quite interesting to examine how these religious guidelines impact the effectiveness of the CACs. And lastly, the paper could benefit from extensions that consider the influence of political stability, governance, and quality, and macroeconomic indicators of the effectiveness of CACs in sovereign bonds restructuring. So in summary, my discussion has sought to critically evaluate Gauzia's paper, which makes I think his paper makes a really good contribution to the field of sovereign bond restructurings. And the introduction of the CAC strength index is particularly really good thing, offering a comprehensive tools for assessing the ease of restructuring process. And I can see this paper undoubtedly adds a valuable layer of the understandings to the complexities surrounding sovereign bonds restructurings. Its finding has a far-reaching implications, not just for the academic discourse, but also for policymakers, the government, sovereign debtors, and sovereign creditors. It opens up to several avenues for future research, as I mentioned. So particularly in understanding the broader impact of CACs on the global financial system. So I'd like to extend my gratitude to Gauzia for this insightful paper. I've learned a lot from the process and for the opportunity to engage with it critically. I also thank the audience for your attention and look forward to your future scholarly discussions on this important subject. Thank you so much.
Thank you so much, Charles. I'll now invite Akshaya to respond with her thoughts.
Thanks, Ishana, and thanks, Gauzia, for your paper. I enjoyed reading it and also listening to you. Now, unlike Charles, who has this is the focus of his research, I my comments and observations on your paper would be more from a more sort of a think of me as a curious outsider to this topic, where looking at insolvency law and corporate governance literature, I'm coming into this. Now, to begin with, I think as the construction of such an index is quite amazing, because even more broadly, I think when we're talking about academic literature trying to find ways to kind of talk to policymakers, people in practice, these are the sorts of innovative outputs we want to see, and this is the way that different industry, academia, policymakers can come together and think about issues. So that's great. In terms of audiences, and maybe let me back up a little. So Charles was talking about looking at emerging markets beyond the ones you've looked at. And I guess I had a bit of a different take on that, because in the past, despite this not being an area of interest for me, but as an interested observer, I've listened to others talk a lot about Latin America, because there's been a lot of stories there out of Argentina, Mexico. So in fact, what I was thinking was that on the one hand, this is quite an innovative index because of the data set. So it looks at countries that haven't quite been the focus of a lot of research and discussion in the past. Now, what the Latin American stories can offer to this, I think, is in your the paper about the index rather than the index itself. If you think of making the paper into a little more academic sort of output, there could be stories from what happened in those countries, and some countries did have CACs, and in some cases, I think there was like a CAC inserted ex post. So these are the sort of things that can bring us insights into what we might see in the other countries based on the political situation, whatever. Now, currently, you already say other things like politics influence these areas, and just bringing some stories from the past, from Latin American countries particularly, may flesh that out and tell us how exactly this plays out. And of course, Charles added very interesting points about Ukraine, Russia, which could add to make it more current, I think. But another point on audience, and that is more on the index rather than the paper. So you were talking about the Reddit TLDR generation, etc. So I wonder if you're seeing, because in corporate governance, we're seeing a lot of retail investors come in, so non-sophisticated investors who are gathering information from Reddit threads, etc. So I wonder if you're seeing sort of a revolution in the bondholder portfolio for you to say that, look, this is sort of easily digestible by non-sophisticated players, because usually in the bond market, we think of hedge funds and, and you mentioned vulture funds. So we think of more sophisticated players. So I wonder if there is some change in the bondholder profile. If yes, it's nice to mention that. And in terms of the government in these emerging markets, do you see them as your audience as well, one of your audience? Because in a way, you're sort of boiling this down into very easily digestible bits and saying that here, please now look at this. It's in a more digestible form than the other international body reports. So maybe that's something to highlight as well as a sort of selling point. And perhaps relatedly, my next comment was, most of these comments are also questions, so there's a lot for you to answer. So perhaps relatedly, my next comment is about, in terms of change, you said that, okay, there's been this international bodies having reports, guidelines, etc., and we haven't seen much uptake. And you mentioned countries where some countries have changed and some countries haven't. And I was wondering, is this a sort of clear resistance to change because of internal politics, or is it just a matter of, they haven't quite, you just need to give certain countries a push in this direction? So if it's the fact that these are just complex conversations, maybe a simple thing like an index helps, but worth thinking about why there has been resistance to change. Is it something beyond just not having these things in simple form? My next comment was, all right, I'd been seeing mostly news reports in the past few months about both the two common places where this happens, New York and the UK, right? Have reports about there being reform proposals to make this irrespective of whether or not you have a CAC, these proposals want to have the same outcome. And those have been critiqued in the sense by saying that, look, it's going to increase the cost of debt, etc. And I wonder if those criticisms can be useful to your own arguments about CAC, and also vice versa. Would the creation of such an index add something to that debate about those reform proposals? And it's good to engage with that, and it just makes the contribution of your paper much more if you do that, because that's very current and you could engage with that. I think I might just have a last point. Okay, so the last thing was just about the IMF's their proposal to have like a international sovereign debt restructuring mechanism so that you can have a moratorium, etc. So again, useful to engage with those proposals and talk about how perhaps just creating more awareness about CACs and the market innovation in terms of these clauses may be a better thing than having some the IMF's proposal, or you may think differently, but just engaging with that and situating everything you're saying in this paper in the context of those different debates and proposals, I think will make it very academically relevant as well. And the more people can draw from it in terms of those current reform proposals and even from other countries beyond your index, I think just it gives your paper more reach and helps have secondary contributions, because it's a valuable apart from thinking of it as a paper, if you think of it as a data source, you've created an index, and the paper then I think can go a lot further by telling people, look, these are all the places in which debates in which this index is relevant, and making those sort of normative contributions, but also opening the conversation up to others to say, look, you can use this data and engage with what I'm saying normatively. I think I can stop there. Those were my points. Thank you.
Thanks so much, Charles and Akshaya. Lots of food for thought for Garcia to respond to. So I'll let Garcia take forward point-wise on what has been responded to by both of you. Go ahead, Garcia.
First of all, thank you so much for such comprehensive feedback. I think we all know that all research is always developing. I always look at research as I look at poetry, where it never ends. You just stop looking at one point of time and stop thinking at one point of time. So this has all been extremely useful, and it's quite heartening to see that there is some use to the index that I created, and that it has way more uses than I anticipated while creating it. So thanks a lot. Thank you very much. So I will just take points from both, and please let me know if I've missed out on something. And the way I look at it is that while some of the comments are definitely going to incorporate them into the paper, I look at the others as more paper opportunities and to capitalize on that as well. But yeah, so to start off, the way the index is working right now is that I release an update on the index every month on the platform, on the Latin Intelligence platform. And interestingly, I included Latin American sovereigns just last week. So I have looked at Argentina, Ecuador, and El Salvador last week. So that is the next leg of developments in the index, are to continue to look at Latin American sovereigns also. Why I started with Asia, Europe, Africa, and the Middle East is because well, one is a functional reason, which is that I'm a legal analyst at RED for the CEMEA region, which is Europe, Middle East, and Africa. And also because I was so exposed to financial distress in a lot of sovereigns in these areas. And being from Asia, I also picked up, of course, we had Pakistan and Sri Lanka who are going through some dire circumstances right now. So that is how it has been progressing. And I look at the index as a dynamic index at this point of time. The 20 sovereigns is just more of a status at this point of time. It is a dynamic growing body as I look at it, and I will keep adding sovereigns and keep researching and looking at bond documentation to add to the index. So that's the Latin America bit of it. In terms of Sukuk, so I actually had, so when I release the index on the RED platform, it usually goes ahead with some form of commentary. And I think I realized that more of it needs to be added to the paper. So the one thing about Sukuk is that whatever the CAC might say and how much ever it might allow for an aggregation, ultimately, since of course, as I mentioned, there is no precedent for sovereign Sukuk restructuring. So I cannot for sure tell you how the CACs will be affected in the practical world. But one thing that can be an informed guess is that whenever a restructuring proposal is made, it will also have to comply with the tenets of Islamic religious law and Islamic jurisprudence. So that's one layer of uncertainty, to so to say, in terms of getting that acceptance from the boards that provide this sort of approval to Sukuk. So whatever the exchange Sukuk or the exchange instrument will be, it will, I think, have to comply with that one layer for sure. So at the moment, I'm rating the CAC, but I'm very aware that there is way more to Sukuk restructurings than the index can encapsulate. When you talk about political stability, of course, that has a big impact on how restructurings go about. Not just that, even if you look at Sri Lanka right now, which is attempting to do an out-of-court restructuring and just starting to negotiate with bondholders. But since last year, it has also been dealing with litigation by a bondholder who now has around 25% of the principal bound, and they have litigation going on in New York. So in the most recent filings made in the court, Sri Lanka has said that, this is going to adversely affect our sovereign debt restructuring. So there is political stability. There's also litigation. There's also, in a way, the global perspective on how the restructuring will go on and how the sovereign is looked upon, that comes into play. And it's just that the effort was also always to make it extremely objective, because the world of subjectivity and the world of factors that can affect a sovereign debt restructuring are just too many, because no two sovereigns will ever have the same situation or be in the same circumstance while having a restructuring process. So that way, I think I have limited the index in that way to maintain its objectivity. But of course, in terms of research that can develop from the index, I totally accept that these are aspects that should be looked at when discussing CACs and when talking about whether a strong CAC is actually strong or is it just strong on paper. So right now, when I look at the index, it is about strength and weakness on paper. And the external factors will come in whenever each sovereign goes through their restructuring, which is why I look at it as just a starting point at this point of time. Moving on also to having model clauses and still sovereigns not including these enhanced tax. Really, it's anybody's guess why it hasn't happened. For instance, like Lebanon has around 14 sovereign bonds that were reviewed, and all of them are weak bonds. Or not weak, they're all single series voting mechanisms. Whereas if you look at sovereigns like Ukraine, all of their bonds have strong CACs. And they came around after the restructuring in 2015. So they clearly imbibed it. and then you, as I mentioned, you also have unanimous voting. And it was surprising to me that even Argentina had some bonds which are yet to mature, which also require unanimous voting, although a lot of the legal precedent and judicial precedent comes from Argentina's case. So really, it cannot be said why they're not adopting it, but maybe they do need a certain push in that direction. And let's see how that happens in the future. Maybe there is more awareness now because a lot of these sovereigns are in the midst of financial distress. So maybe it's a lesson learned in hindsight, I guess, for some of them, or a lesson to be learned from the other sovereign restructurings that are happening to really, take that into consideration. In terms of the New York and UK laws, that's a great point. I think I do need to incorporate that in the paper also in terms of how it will affect CACs in the very existence of CACs, so to say, and also in terms of, it's always that struggle between contracting powers and legislation. So that is a debate that has been ongoing since the start of life. So that is something that I will definitely be including in the paper and make it more comprehensive. And sorry, I'm just looking at my notes to see if I've missed anything. Yeah, so again, even about the moral hazard and about including political and economic variables or talking about borrowing cost, the reason that all of these concepts were not spoken about at all or were limited in a way in the index at this stage is because it is quite a nascent stage of the index itself. And also, while a lot of the sovereigns that I have covered have been in some form of financial distress, a lot of them have not really completed their restructuring yet for me to make that analysis at this point of time. So once I have a set of restructurings that have taken place, and then I can use the CAC index to see whether the strength or weakness of the CAC really impacted the restructuring in actuality. So I think that is something that will be an exercise that will go on as the index develops. And as I find more sovereigns to review, more bond documents to review, and more restructurings, and just a lot of information asymmetry that exists in terms of who the bondholders are and how the decision making happened. There is some gray area there as well. So there is definitely scope for more research that would emanate from the index. And now that I have also started looking at Latin American sovereigns, there is, as you mentioned, there is that possibility of using them and their stories and their the experiences that have actually happened, and to look at how their CACs were in the older documents. So that's a great contribution as well. So thank you very much. I think I've responded to everything, but if not, please feel free to remind me. But once again, thank you very much for your feedback. It has been very, very useful in just understanding the scope of something that has been a brainchild for a very long time now, and it's very heartening to see such a response and to see the interest in the use of the index. So thank you very much, and I'm very grateful for your comments, and I will be incorporating them in the paper as it develops. Thank you.
Thanks so much, Garcia. So much food for thought for you as well to take forward. Perhaps 6 more papers. There's one actually comprehensive and open question that perhaps I could go around the table to respond to and then close out. Is one of the things about a local insolvency regime, particularly for India, was to strengthen the bond market. And that has been on the table for a very long time in terms of what is the best way forward to be able to do a pre-assessment and ensure that there is a strengthening of the bond market. And that was also one of the purposes of having a time-bound resolution domestic insolvency law. I just wanted to sort of go around the table for you, Garcia, from the perspective of your paper, from you, Akshay, from the perspective of policy. Where do you think having a CAC index could assist in the preemptiveness and perhaps further assist in implementing the insolvency law in the manner in which it was perceived to, on a pillar of strengthening the bond market. And from you, Charles, from an international perspective or in other jurisdictions, where this particular balance can be brought in on the implementation of domestic law and using tools like the CAC index to be able to augment and support that particular domestic insolvency legislation. So I just want to go around the table and close it out on that note. Garcia.
Yeah. So first one, so there are two aspects to this question. The first is that when we did talk about the IBC leading to a development in the bond market, I think the focus at the point was on corporate bonds and not sovereign bonds. So in that way, I think there is some differentiation to be made. And in all honesty, I have not looked at as many corporate bond documents as I have sovereign bond documents at this point. But so that is one aspect. The other is that, sorry, and I realize now that I also missed Aksha's point about having a uniform restructuring process for sovereigns generally. Now, the issue is, if you just look at the IBC, the Insolvency and Bankruptcy Code of India, we are still struggling to come up with a cross-border insolvency regime when it comes to corporates. You look at a sovereign, and that is 10,000 times or more complex. The complexities are on many levels, not just going to the very concept of sovereignty, to going to the aspects of politics and economic situations, social norms, etc. So I think in a way, at this point, there have been a lot of efforts, and Professor Paulus also spoke about it yesterday in his keynote, that we have soft laws in place to try and get some uniformity across sovereign restructurings across the globe, but we have not really seen anything concrete yet. But the advantage that I would say the CAC index has, or that CACs have, is that if you have bond terms in the market that seem strong, just using terminology from the index, it will encourage the market to adopt it eventually. And I am aware we've just had an entire conversation about how some sovereigns have still not adopted it. But in the larger scheme of things, it gives you some direction. And to be honest, there is more likelihood of the market driving a change than sovereigns with all their differences coming together and leading to some sort of concrete action. So when I look at the index and think about international restructurings, I think of it as, hey, this is the status quo, this is what is happening. Now, what do we learn from it? And how do we go about having some form of uniformity, even in the contracts themselves, that say bond documentations from 2024, when hopefully a lot more people have seen the index, that they would all include strong CACs, is something that I would think would be the closer hanging fruit at this point of time. So yeah, thanks.
Thanks, Gazia. I'd actually agree with Gazia's first point about them being apples and oranges, but I would like the domestic bond market and the sovereign bond market. But I think the point I'd made about looking at the profile of a bondholder for sovereign bonds, that's kind of something in a different perspective when you're talking about the aims of the IBC, to think about how effective it is. Are we strengthening bond markets, etc. I think one of the things that goes into that is also looking at who are these people who hold the bonds, what are their incentives. So I think that end of research probably is required, rather than hoping it'll randomly strengthen the bond markets. And I think even if it has or hasn't, the best way to know that is to look at what's happening, who those bondholders are. And I think there's been a bunch of such research in different contexts on the widening investor base. So similar research in the bond market specific to India may be useful. Thanks.
Yeah, thank you so much. Actually, so my question is about how collective action clause could benefit the international insolvency market. And I think the role of collective action CACs in the domain of international insolvency is really interesting. And this mechanism, CACs, serve as a powerful tools in mitigating the risk and complications associated with cross-border debt restructuring. For example, one of the foremost benefits of CACs is their ability to streamline the debt restructuring process. Traditionally, the requirements for unanimous consent from all creditors can be significant obstacles for debt restructuring. CACs allows the alteration of the certain bonds terms with the agreement of supermajority, therefore eliminating the problems of holdout creditor who could otherwise stopped the process. And the second thing is about the legal ambiguity. Legal ambiguity is one of the major issues in the international insolvency aspect. Given the multiplexity of the jurisdictions involved in cross-border insolvency, CACs introduce a level of legal certainty by clearly defining the rights and obligations for each party within the contractual framework. So it could provide clarity, facilitate a more predictable and organized approach to addressing insolvency, which making a market more appealing for international stakeholders. And most importantly, CACs can be effective in fostering higher level of coordinations among creditors, different creditors. And they offer mandates to creditors to assemble in meetings, providing an organized forum for stakeholders in discussing their expectations, which provide a forum for them to negotiate terms and reach collective decisions. And this is one of the benefits. And also, the inclusion of CACs can also enhance the investor confidence in the debt issuance, knowing that a structured and democratic mechanism exists for altering debt terms can be things that make the bonds more attractive as an investing options for the investors, for the creditors. And also we can mitigate the moral hazard. I can more holistic CACs can also harmonize the global practice. And I think this is all I want to say. Thank you so much.
Thanks so much for that parting thought, Charles. I think this has been a great session with a lot of ideas on how next steps in terms of research can be taken forward. I want to thank the audience for sitting with us on these two idea papers. The ideation has effectively left a lot of food for thought. We will now move to the working paper and reconvene at 2 p.m. again to talk about constitutional legal remedies and the constitutional conflict between the insolvency law in India and its implementation. With that, I want to thank all of you, Gosia, again, and for the collaboration of Red Intelligence for this particular panel and its event. Akshaya, always grateful to have you on board. And Charles, it's been excellent collaborating with you, and we look forward to much more research that comes out of you on the area of sovereign debt restructuring and sovereign debt insolvency. So thank you all very much for your time from different parts of the world, morning and afternoon, and we will reconvene at 2 p.m. Thank you.
Thanks, everyone. Thanks, Ishana.
Thank you so much. Thank you. See you all.